Welcome to GRE. I'm your host, Keith Weinhold. What is the future direction of interest rates, inflation, and the dollar? We talk to the organizer of the longest-running investment conference in the world today. I ask him those very questions. It's relating broader picture economics to real estate and other asset classes today on Get Rich Education. You can get a 50-year-old house somewhere or buy a new one directly from the builder with tenant-resilient amenities already built in. With over 3,000 Florida units at different construction stages, they are exclusively for investors. President Wagner Nolasco and team also invest strongly in their own product. That's belief. Start at buildtorentdirect.com. That's build the number 2 rentdirect.com or text 407-927-5074. Hey, is your IRA in a real estate syndication? Yikes, a 37% UBIT tax could hit you, but you still have a chance to set up your EQRP and avoid this. Did you make too much money in 2020 and need more deductions? Now federal law lets you set up an EQRP in 2021 and get deductions for last year, retroactively. Even put old IRA and 401k money in Bitcoin, gold, or your own business. Get control of all of your retirement money, tax and penalty free. Text EQRP in all capital letters to 72,000.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Jackson, Mississippi to Jackson Hole, Wyoming, and across 188 nations worldwide. I'm Keith Weinhold. This is Get Rich Education. Sometimes you need to pull back and take the 40,000-foot view of your investments. We're doing that today because, it's interesting. Real estate investing runs the gamut. Last week we got pretty micro, kind of nuanced, talking about quartz versus Formica countertops in rental properties. And today we take a macro high-level view because at times we need to compare real estate to different asset classes to know that we're still doing the right thing here. Comparisons to things like stocks, gold, cryptocurrency, bonds, collectibles, cash even. When it comes to the direction of forces like inflation, interest rates, and the dollar, as I like to say, this matters more to the real estate investor than it does to, say, a retail stock investor. Yeah, it matters to real estate investors more because you're leveraged. If you've got $250K invested in stocks, well, that means that just $250K gets indexed to inflation. But with $250K in real estate, you might have a 75% loan, so you've got $1 million in real estate value, and that all gets indexed to inflation. So in this example, inflation and interest rates affect you 4 times as much as the layperson then. Now, how does money supply affect interest rates? When, say, a lot of money is printed and they're figuratively cranking up the printing presses and pumping money out of a fire hose, does that make interest rates go higher or lower? What do you think? Which one? All else being equal, a larger money supply lowers market interest rates. That makes it less expensive for you to borrow, and that's exactly what's happening right now. And I'm going to be sure that I ask my guest whether he thinks this rampant money creation, hence keeping interest rates low, is going to continue or not. He is also a gold advocate, and I'm going to flat out ask him why the gold price isn't higher today. Now, if you don't understand why high money supply equals low interest rates like this, and vice versa, let me give you a more practical example. Say that there are a ton of rototillers available for you to rent or borrow. Yes, those machines that you take through and chew up and loosen up the dirt there for your garden. Well, if there are a ton of rototillers available for tilling your garden, well, you probably then would not have to pay too much to rent one because it's not a scarce resource. And if you don't pay the rototiller owner a little something to borrow it there down at the rent-a-center, well, then it's just going to be sitting around in their warehouse. And if it's just sitting around in their warehouse, well, then he's more likely to rent out the rototiller at a lower rate. But now, say next spring, when everyone wants to get their garden started, rototillers seem scarce because everyone wants to use one. So since an idle rototiller is scarce, you've got to pay more money to borrow one, like you would pay a higher interest rate to borrow dollars if they were scarce. Ride-sharing services like Uber and Lyft, when everyone demands a car on a weekday at 5 p.m., available cars are scarce, and hence there is surge pricing. My rototiller example is kind of weird, but hey, I think if it helps you remember how an economy works, when the example is kind of off the wall like that, then that's what it takes. And I have never rented a rototiller in my life, but I hear that people do. So anyway, today, with all the additional billions and trillions that the government is creating, there are dollars aplenty. And when the world is awash in dollars, it's more likely that banks will compete to give you a loan because they're all trying to lend out their money. Otherwise, it sits around and earns nothing. But when they're all trying to compete to give you a loan, that makes interest rates lower. They're trying to undercut each other. And an interest rate is your cost of borrowing money. It's more nuanced than that, but that's generally how it works. So this is why high money supply correlates with low interest rates for mortgages and practically everything else today. Now, the Fed, being the one that makes money supply and interest rate decisions, when a lot of money is flowing like it is now, they use terms to describe that policy. They call it easy, loose, or even accommodative policy. That's what you'll hear them call it. Central banks expand the money supply like this to boost the economy. This makes money less expensive to borrow, and it also encourages more spending. Understand that interest rates and inflation do move together. They're typically either both high or both low, because just consider it yourself. This makes it an easy way to remember it. Let's do another example, and we'll leave the farm and garden equipment out of this example. If you want to make a loan to someone and inflation is 10%, you might want to be paid a 14% interest rate so then that you can generate a real yield of 4%. But conversely, if you want to make a loan to someone and inflation is down at just 3%, well, then you'd accept an interest rate of only 7% to get that 4% real yield. You might remember that economist Richard Duncan explained that in his own way here one time. So not only do inflation and interest rates tend to move together, but this is why interest rates usually stay higher than inflation. But things are a bit upside down now. As my guest and I are going to discuss, many interest rates are now lower than the inflation rate. Kind of weird. So imagine what a bad deal it would be for you if you were the bank now. And while inflation is 5%, you're only getting paid by your borrower 3%. Well, now you're losing prosperity. That's a negative real yield. If you were the lender, that borrower is then gaining prosperity. Well, that's exactly what you're actually doing right now as a leveraged real estate investor. You're on the right side of that transaction. Or you're the one borrowing a rototiller. Now, what happens to real estate prices historically if interest rates do spike higher? If we feel like that's where things are going, what happens is that with higher interest rates, real estate prices go higher. Yeah, when people hear that for the first time, they think that I said it wrong because they figure that higher interest rates must mean worse affordability for you and that real estate prices would have to fall. But in fact, I think I mentioned it on the show before. The last 6 times that interest rates rose sharply in America, home prices rose every single time. Why would that be? Because higher interest rates must mean that the economy is strong. That's why rates were pushed up to cool off a hot economy. When the economy's strong and people are employed and wages are going up, they can afford to pay more. In a few minutes, we're going to get predictions about the future direction of interest rates, inflation, and the dollar from the host and organizer of the world's longest-running investment conference, the prestigious New Orleans Investment Conference. I expect to be there in New Orleans next month. It is October 19th to 22nd. Join me by signing up at getricheducation.com/events. That is a live in-person event. But before that, join me for a live virtual event this week. There's a webinar this coming Thursday. It's a chance to reserve brand new construction income property for yourself in Texas. We're talking particularly about, I suppose, the northeast quadrant of Texas. As you know, real estate investors love Texas because it is just about the most stable and safe place to invest that I can possibly think of. A big influx of people, a diverse economy, and Texas has numbers that work fairly well. I mean, if the Texas economy took a dive, then you know what? The entire nation probably would have as well. Now, one of the problems of investing in Texas property is that you have to consider the higher property tax rates there. As high as 3%, the rent-to-value ratio does not consider property tax. Well, this provider that's going to be on the webinar with me has a proven strategic way to steer around the property tax impediment. They've been doing that for years. See, because the properties are brand new construction, in the early years, you benefit from the fact that your tax assessor was still assessing the property before any structure was built there. So it's a really low assessment, lower tax, and it takes time for the assessment to catch up. There is more nuance to it than that, but that's the general strategy that's been proven to work. It's not a trial. In fact, we had the first one of these webinars about 6 months ago, and now they've got more new build property getting ready to go. Of course, there's a property management solution there for you too, if you wish to use them. Learn about it all on the webinar this Thursday. Here is one of the lower priced properties they have. I am looking at it here. It is just a hair under $200K at $199,900. It is in Sherman, Texas, which is getting up close to the Oklahoma border. This is a 3-bed, 2-bath. Again, it is brand new build. It's a ranch home. It looks really good. It's 1,300 square feet. I don't see the estimated rent amount there. It has granite countertops and vinyl plank flooring, and the property prices generally go up from there. Join the provider and I live on the webinar. Get started at getricheducation.com/Texas. And if you've already left your information there, you visited that page before, well, then we're going to be sending you the webinar link. Again, it is for this coming Thursday afternoon, and it is something that you'll want to attend with us live because it is your chance to reserve real properties. You will have a chance to ask questions too. The Texas Properties webinar this Thursday. Get started at getricheducation.com/Texas. I'm Keith Weinhold. More straight ahead. The people that our listeners can't stop talking about are Ridge Lending Group, NMLS 42056. They've provided GRE listeners with more loans than anyone, and it's where I got my last few loans. They finance single-family income property up to 4plexes. They're the #1 lender for beginners and veterans. Start your pre-qualification, chat with President Chaley Ridge personally, and get your custom plan for expanding your cash-flowing portfolio. Start at ridgelendinggroup.com. You know, a lot of investors choose either cash flow or home price appreciation, but one real estate market could provide both: Jacksonville, Florida. They've got 27% lower home prices and higher rents than the national median. Their market has appreciated 34% more than other comparable cash flow markets over the last 30 years. Get positive cash flow today and above average appreciation for tomorrow. They often have available inventory in Jacksonville, if you can believe that. Start at cashflowandgrowth.com.
This is author Jim Rickards. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
I'd like to welcome in the host of the longest running investment conference in the entire world, the prestigious New Orleans Investment Conference. It takes place next month in New Orleans in just a few weeks here. I will be there. He's also the executive director of the Gold Newsletter. It's good to have you back on GRE. Welcome in, Brien Lundin.
Great to be with you again, Keith. Thank you so much for the opportunity.
Yeah, I'm really looking forward to coming back to next month's conference. You've had such prestigious speakers there over the years, from Margaret Thatcher to Steve Forbes to Milton Friedman, Alan Greenspan, Gerald Ford have been there. So before we're done here, I want to hear who this year's speakers are going to be. But we are real estate investors here predominantly on this show. So before we pivot and talk about some bigger macroeconomic things, Brien, I'd just be very interested in your big picture view on real estate. In a sense, we're really at a lot of extremes in the residential market anywhere. We've got higher prices, lower interest rates, historically low supply, and now this year rents are spiking. So from your big picture view, how do you evaluate the real estate climate today?
It's important to remember what created that climate, and that's been easy money, ultra low, even negative on a real inflation adjusted basis, interest rates. The Fed is starting to talk about when it will start rate hikes and trying to normalize that, when it will start tapering back, quantitative easing, et cetera. And my operating thesis is that don't worry, we're not going to get interest rates rising to any appreciable amount. We may not even see the Fed begin to taper at all because they can't. They are really in a trick box right now. So the good times, I believe, will continue to roll. And of course, there's always going to be wiggles along the line on the uptrend as we go ahead. But the environment that has been conducive for a buoyant real estate market in general, and of course, it all boils down to location, but the environment that's been conducive for that will continue because it has to continue. The Fed is, given the size of the federal debt, et cetera, and for many other reasons, the Fed cannot tighten monetary policy appreciably, and therefore it's going to be a real tailwind for real estate going forward.
Okay, so just some translation here. A Fed tapering would mean a tightening of policy somewhat. So we talk about a Fed taper. Currently, the Fed is buying $120 billion a month of treasuries and mortgage-backed securities, which has the effect of pumping liquidity or dollars into the market. And for example, a tapering, we'd be taking those purchases from $120 billion a month down to, say, $80 billion a month for a few months, and then $40 billion a month for a few months. That's what you're saying they cannot do, and interest rates, in your opinion, are going to continue to be persistently low over the intermediate term, at least here?
Yeah, tightening, normalization of monetary policy will take those two steps. First tapering, then interest rate hikes, if they can get very far down their road. And also there's kind of a duopoly on why they can't do this or get very far down their road. One is the federal debt. They can't raise interest rates because the cost of servicing that debt burden would basically crush the federal budget and overwhelm any other spending. And number two, they've created this financial house of cards, primarily pumping up asset prices in the stock market, as well as bonds and real estate as well, trying to really float the economy higher on an ocean of liquidity. They can't withdraw that liquidity at this point because these asset classes are dependent upon it. They try to throttle back that support, then these markets will throw a hissy fit and tell the Fed, no, you can't do that. And they will take those marching orders, as it were. So that does create other issues, other problems. But the bottom line at this point is that they can't afford to let these markets decline to any great degree because it would threaten to bring the economy into a very deep recession. And they're not going to let that happen.
Now, isn't the Fed between a rock and a hard place? Because inflation and interest rates are positively correlated. Generally, when you have higher inflation, the tool that the Fed uses is higher interest rates to cool this overheating economy and tamp down on inflation. But with inflation, at least on a CPI basis, at 5%, on a PPI basis, running higher than that lately, the Fed can't raise interest rates to go ahead and get on top of that. I mean, are they in a rock and a hard place? Because their classic tool for controlling inflation, interest rates, is what you're telling us that they really can't raise? Or do you feel that inflation is transitory and will come down? What are they going to do?
Yeah, I don't feel inflation is transitory. I think there are a lot of factors, a lot of drivers for inflation that are deeply, deeply rooted, primarily in commodities, really supply constraints, rising demand curves for a lot of commodities that would take really a decade or more of really high prices to alleviate. That's going to keep on. Inflation is here, at least higher inflation. We may not see inflation in the 5 to 6% range from the CPI like we've seen over the last couple of months, but it will be far above the Fed's 2% target. So that's one issue. Now, what they can do on interest rates, they can raise interest rates, but they have to keep interest rates below or well behind the rate of inflation. So they can't really snuff it out. So inflation is running at, say, 5% annually. They really can't raise rates more than, say, 2 or 3% because they need significantly negative real rates, rates that are negative, yields that are negative, adjusted for inflation. So they need that to be in the 1 to 2% negative real rate range going forward. Otherwise, you get those pressures, cost pressures on servicing the debt. For real estate investors, that's fine. You can have 3, 4, even 5% interest rates. I mean, that's typically normal or even low for what's normal over time. You can have interest rates at those levels if the inflation rate, if the value of the underlying assets is increasing at a significantly higher rate than those interest rates. So that's why I say for real estate, the macro situation is going to be conducive, in my view, for as far as the eye can see.
It's interesting, Brien. Consumers don't want to see price inflation as they see everything from dish detergent to avocados go up in price and the purchasing power of their dollar diminishes. But something that a gold person like you and a real estate person like me have in common is, in a sense, we kind of cheerlead against the dollar because real estate investors tie up a lot of long-term fixed interest rate debt. And then the gold price goes up in dollars, gold being that classic hedge against dollars. So it's sort of interesting that we often find ourselves cheerleading against this in a way if we've structured ourselves and aligned our interests with what we think that the Fed is going to do and effectively create more dollars and debase each individual dollar. Last month, we had quite the milestone when gold and dollar intersect because last month, on August 15th, of course, we had the 50th anniversary of President Richard Nixon depegging the dollar from gold, which really opened up a whole new slew of inflationary pressures that have really been mounting for 5 decades now. Part of that Nixon speech that a lot of people don't talk about, Brien, is that Richard Nixon, in that speech 50 years ago, said that the dollar is going to be worth just as much tomorrow as it is today. That's certainly not true. He had to say that to assuage the public. And we know that on a CPI basis, if you want to believe the CPI, which a lot of people has understated, the dollar has lost about 85% of its purchasing power over the last 50 years. So what are your thoughts there in the future direction of the dollar, Brien?
It depends on how you measure it. And I'm glad you brought up that Nixon closing the gold window and depegging the dollar in gold on August 15th, 1971, because that's really when Gold Newsletter, our flagship publication, was launched by my late business partner and mentor, Jim Blanchard. He heard Nixon's speech. He knew that Nixon, another thing he said was that this was a temporary measure. Going on 50 years, over 50 years, we're still waiting for it to be rescinded. That's when he decided to launch Gold Newsletter to advocate for the return of gold ownership, legal gold ownership to the American citizens. Back then, you couldn't legally own gold. It was up there with heroin and plutonium. You couldn't own it. The government didn't want you to have that protection against what was to come. Jim saw what was to come, and that was the rapid devaluation of the dollar. And then you have to look at how you measure the dollar. You look at the dollar index, you have to realize that that's really the dollar's value against other fiat trade currencies. So it really doesn't value where the dollar is. The real judge of the dollar is what you also mentioned, its purchasing power over time. And the best gauge for that is not just the CPI, but the gold price. So when gold's going up, the value of the dollar relative to gold is going down. And gold its primary function, again, is as insurance against the dollar losing that purchasing power over time. It isn't a direct one-to-one correlation with inflation or the loss in the dollar's purchasing power. Sometimes people don't want to own gold or don't feel the need to own gold because they think things are just hunky-dory as they are, inflation's low, et cetera. But when they start to get worried about where the purchasing power of the dollar and whatever their currency is, they buy gold because it is the age-old hedge and insurance against that depreciation and purchasing power. And that's when gold plays catch up and really its value relative to the currency rises. That's what we're seeing right now. And that's what I think we're going to see over the next 5 years or so, because these trends are kind of coming to a head. The dollar has to be depreciated. Every fiat currency has to be depreciated because the cost of the debts have risen so highly. And gold's going to be the main beneficiary of that macro trend. It's going to be the primary insurance against the effects of that macro trend.
Robert Kiyosaki was here with us last month discussing that 50th anniversary of the dollar being depegged from gold, because to people in the finance world, that's a pretty significant event. But most of the public really isn't even that aware of this or understand the value of gold. And gold is one of the very few assets that's had sustainable value for millennia. You just can't say that about very many things. In fact, in the event of a crisis economically, I think it protects people from getting wiped out better than just about anything that I can think of. So in a sense, it's a great money insurance or currency insurance policy is one way that I like to think about it, Brien. And some people think of it as an investment. Some other people think of it as more of a hedge. Brien, I told my audience that I made a substantial investment in gold this year for a few reasons. Number one is more inflationary pressures. And number two is, Brien, in my opinion, gold has not had this great price run up like almost every other asset seems to have had, from stocks to real estate to cryptocurrency. So really, that's another reason that I wanted to buy gold. I feel like it's a pretty good value right now. Gold this year has generally been trading in a range between $1,700 and $1,900 an ounce. But maybe some wonder, Brien, and really me included, is why isn't the gold price higher here where we printed massive dollars going back about a year and a half ago with what's happened with this exogenous shock in the economy? Why isn't the gold price higher?
One thing we have to recognize is that gold did have a huge run from the early days of March when everything kind of cratered. And then it rebounded very quickly and had a tremendous run to the early days of August of last year. The resulting correction has kind of been a digestion of that huge move higher. And we're still higher than where we were before the pandemic, significantly so. So what is gold telling us today? It predicted a lot of what we saw in the Fed policies, the Fed easy money policies that came in after the pandemic, and the fiscal spending that we're seeing right now. I think what gold is about to tell us are really a couple of things: that inflation is not transitory, it's here to stay. And two, that the Fed really can't do an awful lot about it right now and is going to remain powerless. If and when the markets realize that and start to try to factor that in, they're going to be buying gold hand over fist. And I think right now we're in that transition period where the markets, or at least the professional investors that set the prices of gold, of stocks, of bonds, those investors are believing what the Fed is saying, that it will be transitory. And once the Fed is proven both wrong and impotent, then I think you're going to see a mad rush into inflation protection assets. That would be gold, silver, all tangibles, and of course, real estate.
So connecting the dots here, Brien, with higher inflation expected to persist and the Fed not having the ability to raise interest rates to tamp down on inflation, this can therefore increase the value of everything that's denominated in dollars, especially those classic assets, including things like gold.
Yeah, gold, collectibles, real estate, things like that. Now, there are ways, to actually make money on this macro trend. Of course, income producing real estate protects you by not only producing income, but the asset itself rises in that kind of an environment, typically on pace with inflation, or even more depending on where it is. Gold and silver are the classic monetary metals that protect against the depreciation of the currency and inflation. If you want to leverage that trend, then you can get into the trend specifically for gold and silver and other commodities. You can get into mining stocks. We cover a lot of those in particularly the junior mining stocks in Gold Newsletter. That's another really typical or classic way to leverage what you see as fundamental trends that are driving the prices of the metals higher.
Brien, when I go to conferences and attend workshops in those conferences, including ones that you have at the New Orleans Investment Conference, often when there are some younger people who are in the audience at a gold workshop, one takeaway I get from them is they kind of start nodding their head like, yeah, maybe I should consider buying and owning gold. Like it's something they had just never even considered previously. So with that in mind, and you mentioned junior mining stocks and some other things, how do you recommend that one holds gold if they want to get a hold of some? Should they get sort of a derivative product like a stock, or is it better for them to physically stack Engelhard silver bars and Pamp Squeeze gold bars, either hidden around their home or in a safe deposit box? How do you recommend that one hold gold and precious metals?
That's the first step I tell anybody. And as you know, over the last 8 or 9 years, I've gotten involved with a lot of the movers and shakers and thought leaders in the real estate markets. And therefore, I've been exposed to a lot of people who are new to the sector, but like you say, are getting it and understanding the real role of gold and want to get involved. So I tell them it can be very confusing. There's a lot of different ways, and within each method of investing, there's another spectrum of opportunities and risks as well. So step number one is get physical metals, not necessarily the paper derivatives, but get the physical metals and get them in either your direct possession or close accessibility, not safe deposit boxes, because one of the things you're insuring against is bank closures and the like. Gold and silver, get a bit of both. Silver moves more than gold percentage-wise in both directions. Important to realize that too. On the way down, it outperforms gold as well. So get a little bit of both. I like junk bags of silver. The old U.S. silver coins are a great way to hold silver. It's kind of bulky, but it's small denomination, and they're just neat to look at. So I do like those as well. There's a report on our website on goldnewsletter.com that's free called The Investor's Guide to Gold and Silver. Goes into all the different areas, but get that physical metal holding first to insure yourself against wealth destruction as the dollar's purchasing power appreciates. After that, then you can talk about investments. You can look into investments that would leverage that move, and mining stocks are one way to do that.
You, the listener and viewer here, might want to identify a nice spot in your backyard for digging a hole, if you will. And don't forget, in a few months, the ground is going to be freezing in wintertime, depending on where you live. So you might not be able to recover that. But yeah, so physically, then it doesn't have any counterparty risk. It's not a derivative. You're holding on to the real thing, real gold and silver. Brien, I attended your prestigious New Orleans Investment Conference 3 times previously, 2014, 2017, and 2018. And I think one thing that's different this year is the growing role of cryptocurrency, especially Bitcoin, the biggest cryptocurrency by market cap. In fact, just this month, we saw El Salvador become the first nation in the world to make Bitcoin legal tender. And critics of cryptocurrency, I think chiefly they might say that cryptocurrency is not backed by anything, but yet supporters of cryptocurrencies like Bitcoin say, hey, this is money that's tailored to be used in the internet era. And there are only ever going to be 21 million Bitcoin. So it has a fixed supply, unlike dollars that can be and have been printed profligately. So what are your big picture thoughts with cryptocurrency today, Brien?
I was just at another conference in Las Vegas earlier this week on a panel, Gold versus Crypto. And like all of the gold versus crypto panels that I've been on, it's been less of a us versus them, is kind of a kumbaya moment. Let's all hold hands and get out of the dollar into alternative investments and get out of the government's control. I think crypto is a worthy asset class. I think it's something people should look at and understand. There is a learning curve, but understand it. And I think it's something that's laudable in its goals and offers real advantages. I don't think you should own it to the exclusion of gold. And I think everyone should look at owning some crypto. The things that concern me about crypto are that many of its use advantages, or many of the original reasons to own crypto, like getting out of the government's purview, are being lessened by crypto's desire to get under the regulatory umbrella of the SEC and the like, and being regulated, and the government paying attention to regulating the coins somewhat. So I think that's hurting it. And I think central bank digital currencies are going to take away some of the uses of crypto. So it's an evolving landscape. right now, and it is speculative, and people are speculating in it. It's something that I think people should look at owning, but they needed to educate themselves on it before they do so.
Yeah, but it's about embracing that commonality sometimes between crypto investors and gold investors and real estate investors that have long-term fixed interest rate debt. We're all interested in shorting the dollar. We're all basically making a bet that the dollar is going to go down in terms of purchasing power. Brien, your New Orleans Investment Conference is prestigious. It is the longest running investment conference, not just in the United States, but in the world. There's just really a great feel of professional polish there. I always have an excellent time. New Orleans is a fun city. So tell us more about this year's New Orleans Investment Conference and some of the speakers that you're going to have.
We have been dead set to have another in-person event. We were virtual last year, and by hook or by crook, we're going to be in person. And I was able to get my personal wish list of speakers to come. And it is going to be an extraordinary event. We've got Dr. Ron Paul, we've got Jim Grant, we've got Jim Rickards, Danielle DiMartino Booth, Jim Iurio, Doug Casey, Rick Rule, Peter Schiff, Dave Collin, Grant Williams, Dominic Frisbee, and the list goes on and on. George Gammon, Brent Johnson, Peter Bookbar, Mark Skousen, the real estate guys, on and on and on, dozens of the people, the very people that I think are the thought leaders today, who have the best insights, who can really bring value and give you a peek behind the curtain about what's really going on. Really well thought out forecast of where the economy is going on, and specific ideas on what you need to do right now to protect yourself from the risks, which are extraordinary, and take advantage of the opportunities, which are equally extraordinary in this kind of an environment.
And for the attendee, I kind of think of three different activities that one can do. Principally, we're in sort of that main event hall where you have the big stage with some of the speakers that you mentioned. Additionally, one can go across the hallway over into the exhibit room where all the tables are and visit with those people. And then alternatively, there are those breakout sessions in the smaller rooms upstairs if you want to attend some of the particular topics that interest you, whether it's resource extraction or real estate or cryptocurrency or oil and gas or gold and silver or whatever it is.
Yeah, and one of the best resources at this conference, if not the best, are the other investors. Think about it. You're traveling to New Orleans, a destination in itself, and you're surrounding yourself by hundreds of investors who have the same goals, who not just don't necessarily think similarly, but have the right approach toward investments. So you're getting new ideas, you're getting new opportunities. All of these people have self-identified as being very smart, very curious, and very successful just by the fact that they're at this event. The intellectual energy, the ambiance in the halls, that's what we were missing with the virtual event last year. And that's why we were so dead set to have the event this year back in person, so we get that kind of networking effect that we were missing before. And it's so special, not just to these kinds of events, but also to the New Orleans conference, because it is unique amongst all conferences out there. It does have a certain entrepreneurial, more libertarian feel to it. And that's the kind of people that show up there, and they're worthy of talking with and listening to. They want to hear what you have to say as well.
It's October 19th to 22nd in New Orleans, Louisiana. It's the New Orleans Investment Conference, a 4-day-long conference culminating with Dr. Ron Paul speaking on the final day. If you want to get signed up, hey, we'll get to meet in person as well. You can do that at getricheducation.com/events. Brien Lundin, it's been so good catching up with the state of the economy. Thanks so much for coming back onto the show.
Great, Keith. It's been a wonderful experience as usual. Please, anytime, and thank you for the opportunity.
Yeah, Brien thinks the good times will roll. More easy money, more dollars printed, more low interest rates, a real boon for real estate and other asset classes going forward. He thinks that interest rates will need to be kept a good 1% to 2% below inflation. Yes, they are those negative real yields that we're talking about there. I hope that you can join Brien and I in the illustrious speaker lineup in New Orleans in a few weeks here. At the conference, you will see that presence of their gold legacy there, but they've really branched out into probably nearly every asset class with a growing real estate presence. What about a gold-backed cryptocurrency? Well, that's the type of thing that you can get insights and opinions on there as well. And besides the conference, you might want to stay some extra days for all of the great things that New Orleans is known for, like Bourbon Street and the French Quarter, or maybe like the more laid-back vibes, like the more low-key but vibrant Decatur Street. There's a good aquarium there. There are boating tours for seeing alligators just outside of the city. The Hilton along the Mississippi River is where they both have the event, and it is the host hotel to stay at, too. I really think of it as the preferred place to stay. I like to lift weights at their gym there at the Hilton and go running along the Riverwalk in the morning. It parallels the Mississippi River. Hey, maybe you and I could do that together. A lot of people want to see the former presidential candidate Ron Paul. He really is revered as a champion of liberty to a lot of people. It is October 19th to 22nd. Big thanks to Brien Lundin today. Hey, let's meet in New Orleans. The place to sign up is getricheducation.com/events. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.